When people think about the fall of Rome, they imagine dramatic scenes. Barbarian armies at the gates, collapsing legions, emperors blinded by the poison of power. But empires rarely fall because of invasion alone. They decay from within. And one of the most corrosive forces that speeds that decay has always been money. Rome didn't fall because of wars or corruption. It fell because its money collapsed. And the lessons from that collapse still echo for every modern economy that thinks it can play games with value and get away with it. Let's set the stage. For centuries, the backbone of Rome's economy was the silver denarius. First minted around 200 BC, it was almost pure silver, trusted across the empire and even beyond. Roman soldiers were paid in it, merchants demanded it, and citizens stored their wealth in it. The denarius wasn't just a coin, it was trust-made metal. As long as people believed in Rome, they believed in its money. The empire's strength and the coin's value were one and the same. But running an empire is expensive. Legions had to be paid. Roads, aqueducts, and fortresses had to be built. Wars on every frontier drained the treasury. By the 2nd century AD, Rome was stretched thin. Germanic tribes in the north, Parthians in the east, rebellions within. Tax revenues no longer covered the costs. So emperors turned to an old and dangerous trick. They devalued the money. Raising taxes was unpopular. Minting cheaper coins was easier. The numbers tell the story. Under Emperor Augustus, the denarius was about 95% silver. By the time of Caracalla, it had fallen to 50%. By the mid-3rd century under Emperor Gallienus, it was less than 5%. A coin once made of solid silver had become a bronze disc with a thin silver wash. And the people noticed. The result? Inflation. When money lost its anchor in real value, prices exploded. A measure of grain that once cost 1 denarius could suddenly cost dozens. This wasn't abstract economics. It wrecked ordinary lives. Soldiers demanded higher pay to survive. Merchants refused debased coins, demanding gold or goods instead. Local economies reverted to barter. And as confidence eroded, emperors struck even cheaper coins, hoping quantity could replace quality. It never does. The same vicious cycle that would repeat in every inflation thereafter had begun. The crisis reached its peak in what historians call the 3rd century crisis. From 235 to 284 AD, Rome suffered nearly 50 years of chaos, invasions, plagues, civil wars, economic collapse. Emperors rose and fell in dizzying succession, some ruling only months before being assassinated. Behind the political drama was a broken financial system. Taxes were collected in worthless coins. Farmers abandoned their land, trade networks fractured. The government tried desperate fixes, price controls, forced labor, new taxes. None of it worked. One emperor, Diocletian, tried to stop the bleeding. In 301 AD, he issued the Edict on Maximum Prices, fixing the cost of thousands of goods and services, from wheat to labor wages. Breaking the law could mean death, but it was a disaster. You can't freeze prices when the money itself is melting. A black market exploded and official trade collapsed. People learned quickly, no law can make bad money good again. Eventually, Rome abandoned the denarius altogether. In 312 AD, Emperor Constantine introduced the solidus, a gold coin of consistent purity. It restored stability for a while. The solidus survived in the Eastern Byzantine Empire for centuries, but the Western Empire was already mortally wounded. Debasement had hollowed out its economy. Armies could no longer be paid. Trade collapsed. Trust vanished. Rome didn't fall overnight. It unraveled slowly, thread by thread. And the collapse of its currency was one of the sharpest threads of all. What does this mean for us today? The destruction of money is always the destruction of empires. Rome thought it could trick its people, minting coins that looked the same but contained less value. Modern governments think they can do the same, printing paper, manipulating interest rates, inflating away debt. The result is always the same. People pay the price, wealth evaporates, and trust collapses. Rome learned that lesson the hard way. Ignore it, and we'll learn it the same way. History didn't stop with Rome. Every major inflationary collapse since then has followed the same pattern. Governments debase money to pay their bills. Elites protect themselves with real assets. Ordinary people are left broke. Rome's crisis was just the first full-scale example, a blueprint for collapse. Fast forward to the 20th century, and the echoes are deafening. After World War I, Germany faced crushing reparations under the Treaty of Versailles. To pay its debts, the government printed marks, just as Rome had once struck more coins. By 1923, hyperinflation was raging. A loaf of bread that once cost 1 mark now cost 200 billion. People carried their wages home in wheelbarrows. Pensioners watched their life savings vanish overnight. And as in Rome, those with debts saw them erased, while those with land, factories, or foreign currency became richer. Money lost all meaning. Economic despair fueled political extremism, paving the road to Hitler's rise. The same story repeated in Zimbabwe in the early 2000s. Land seizures, collapsing production, rising debt, the government turned to the printing press. By 2008, inflation had reached an unimaginable level, 89.76 sextillion%. Prices doubled every day. Shops couldn't change tags fast enough. Eventually, Zimbabwe abandoned its own currency altogether, forcing people to trade in US dollars and South African rand. Once again, a government thought it could cheat reality, and once again the people paid. But you don't have to look only at the extremes. Even modern developed economies still follow Rome's pattern. Take the United States. In 1971, President Richard Nixon took the dollar off the gold standard, cutting the last link between money and tangible value. From that moment, the dollar became a fiat currency, backed not by gold, but by trust. And just like Rome, the temptation to overspend became irresistible. Over the following decades, debt exploded, the money supply ballooned, and inflation became a quiet thief. We may not wheel cash in carts, but our purchasing power erodes year after year. A dollar from 1971 buys what takes over $6 today. The bills look the same, but their value has been hollowed out. The game hasn't changed. Governments sell inflation as growth. They tell citizens their wages are rising, while prices rise faster. They call debt investment, even when it funds consumption. They point to soaring stock markets as proof of prosperity, though most people own no stocks at all. Like the emperors of Rome, they pretend nothing fundamental has changed, even as they quietly drain value from every coin, every bill, every paycheck. What makes today more dangerous is scale. Rome's collapse was imperial. Weimar's was national. Zimbabwe's was local. But today, the entire world runs on fiat money, colossal debts, and central banks ready to print trillions at the first sign of trouble. That means the next collapse won't be confined to one empire or one nation. It will be global. And history tells us who will suffer most. Not the elites who hold assets, but the millions whose wealth lives in salaries, pensions, and savings. So what can you, as an individual, learn from Rome's currency crisis? First, inflation is not an accident. It's policy. The silent tax that has broken empires for 2,000 years. Second, real wealth isn't on paper or screens. It's in what holds value when money doesn't. Land, skills, productive work, resources. And third, never assume stability is permanent. A Roman in the 1st century would have laughed if told his coins would one day be worthless. Germans in 1913 would have scoffed at the idea of wheelbarrows full of cash. Zimbabweans in the 1980s believed independence meant prosperity. Yet every time the same story unfolded. Rome's collapse reminds us that financial systems fail slowly, then suddenly. When money stops being real, society starts to crumble. Contracts break, trade halts, armies dissolve, governments lose legitimacy. The barbarians at the gate may finish the job, but the real killer is always inside the treasury. And here's the truth. History doesn't repeat word for word, but if you fail to understand it, it will crush you just the same. The fall of Rome wasn't just about bad emperors or greedy elites. It was about the fragility of money when power abuses it. And that fragility has never gone away. If this gave you a new perspective, subscribe. History still speaks. You just have to listen.